This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh, and in today's video I wanted to give you a portfolio update on my Sharesies public portfolio. This month's update, I wanted to talk about some of the key news that's happened with some of the stocks in the portfolio, like Oceania Healthcare, which reported results yesterday, and other stocks that's performed quite either badly or really well, such as Colins Foods as well as Kogan. And I'll show you later on as well that I have transitioned my portfolio data from using my spreadsheet into Sharesight now that Sharesies and Sharesight are now partnered up, and now we can easily integrate your data onto there. So I'll show you how the portfolio looks like on Sharesight, but if you're interested, I will release a video shortly, soon, maybe tomorrow, on how you can get started with Sharesight on your Sharesies account. So it'll be a step-by-step guide. I basically go through how I did it personally there. Alright, so if you enjoyed today's video, be sure to hit like and subscribe, and remember, none of this is financial advice. I'm not recommending you to buy, hold, or sell any of the stocks that I talk about in this video. So without further ado, let's get right into the video. As you can see over here, the current Sharesies public portfolio is worth $23,523, and Sharesies decided to refresh its page. But as you can see over here, the simple return is 20.53%, and the gains have actually gone down quite a bit. Towards the end of October, it was 5,600 in profits, but now it's dropped down to just under 4,000. There's a lot of jitters in the market at the moment, and so it's affected the portfolio quite a bit, which I'll show you on later on Sharesight. But here are the positions. In terms of positions, nothing has changed since the update 2 months ago. So I still have shares in Auckland International Airport, Colins Foods Limited, Heartland Group Holdings, Infratil, Kogan, Macquarie Group Limited, Oceania Healthcare, Centre Group, as well as the benchmark NZ Top 50. But now that we have Sharesight, we can sell this $1 ownership in the NZ Top 50 fund. So over here, I have the Sharesight dashboard, which shows us the performance of the Sharesies public portfolio. So I've already integrated all the data onto Sharesight, but as I said, I will release a video soon on a step-by-step process on how to do that. So this is my performance over the past year. As you can see, the portfolio has delivered close to 11% returns versus the NZ Top 50 ETF of 5.12%. So overall, the portfolio is beating the index. And you can see that since the first purchase, the portfolio has also outperformed the benchmark. So I'm using the NZ Top 50 ETF over here because I think this is the most relevant benchmark, given that most of the shares that I hold are based in New Zealand. All right, so it's taking a little bit of time to load because there's a lot of data. I've dollar cost averaged in throughout the start of the portfolio since August 2019, so it needs a lot of time to crunch the numbers here, but we'll give it some time. And here we are. So as you can see over here, there's 4 different colors. The first one is the Sharesies public portfolio, which is how well the portfolio has performed, and this is the benchmark, which is the NZ Top 50 fund. And we also have the NZX green color line over here, and this NZX is not the NZX performance, but rather the performance of all the NZX stocks that I own. Alright, so I'm gonna hide this over here, as well as the ASX, and as you can see over here, the portfolio has outperformed the benchmark by about 3,000 basis points since the start of the account. So the start of the account was in June 2019, sometime then. Alright, so as you can see over here, here are my positions, and you can see since the first purchase the total returns, but I'm gonna just look at the past month because the portfolio updates are on a monthly basis. So as you can see, the ASX overall has delivered a negative $81 return, and also the NZX has returned $736 of a loss, right? So the NZX has done a lot worse than the ASX, and the ASX was boosted by Colins Foods and Centre Groups. So this is the portfolio tracker going forward. I won't be using the spreadsheet anymore. This is just way more effective. And if you're interested in signing up with Sharesight, I do have a referral link down below. If you use that link to sign up for a 12-month plan, you will get 4 months for free. So now I'm going to show you the diversity report, which is basically a pie chart of how your portfolio is structured in which type of industries. So that's very similar to the pie chart that I had in my spreadsheet. So all you need to do is go into reports and go into diversity report. And this diversity report is as at the end of November 2021. And as you can see, 24% of my portfolio is in medical and nursing services, which, as you know, is in Oceania Healthcare, and real estate development, which is Center Group, is my second largest position. So this is just the industry code that they have been allocated into, and the industry names over here can be quite arbitrary. So if you do want to change that, you can go into custom group settings and set your own industry name. And this is very handy as well because, for example, I didn't actually record last month's data, closing data at the end of the month, but I can just simply go in here and change the data and see what the portfolio was like. So as you can see over here, Oceania Healthcare was 21% of the portfolio last month, whereas in this month it has gone up to closer to 25%. So that's one way that you can compare month-on-month movement. So now let's talk about some of the news that's happened with the stocks. The first one is Oceania Healthcare. They reported half-year results yesterday. So I've gone through the results. I've listened in on the conference call. Overall, this result was not bad at all. By not bad, I mean it wasn't great, but it wasn't terrible either. So Oceania announced an unaudited pro forma underlying EBITDA of $36.5 million for the 6-month period, ended 30th September 2021, a 19.7% increase or $6 million increase on the 6-month period ended 30th September 2020. So on first glance, a 19.7% increase in EBITDA is a very good result. However, you have to remember that Oceania did issue quite a number of shares this year. So just bear that in mind, because when you issue more shares, then the profit gets split into more shares, right? So on a per share basis, it won't be as much of an increase, right? So EBITDA has gone up 19.7%. Other key things to note as well is that sales volumes were quite strong, 10.6% ahead of the 6-month period. They also completed an acquisition of Waterford in April 2021. But listening on the conference call, however, it was quite disappointing that Waterford didn't actually contribute a material level of earnings to Oceania in this half year. So the reason for that was COVID obviously did impact a lot of business activity in Auckland, and Waterford being in Auckland was impacted. So hopefully we'll be able to see some benefit from this acquisition in the next half of the year. Now, other key things that you need to know about is that the interim dividend of 2.1 cents per share was announced, so that's an increase from 1.3 cents last year, and the dividend reinvestment plan will apply. So what I'm planning to do is participating fully on the dividend reinvestment plan for my shares held on ASB, because Sharesies currently doesn't offer a reinvestment plan, but for my private account I will fully participate, given the share price for Oceania right now is trading at a relative low. So other key things to note as well is that underlying net profit was 27.5 million. That is an increase from 22.5 million, and a 22.2% increase. Now I calculated this on a per share basis, and earnings per share was 3.9 cents per share this half year versus the prior year was 3.6. So that's an increase of roughly 10%. So it's not as impressive as 22% over here, because as I mentioned before, the share count has increased quite substantially. So it's diluted shareholders' earnings. And so the underlying earnings on a per share basis is only 10%, which is why I say, it's not a great result, but it's not bad either, considering the impact COVID has had on the business, especially its high concentration in Auckland as well, meaning that it's been affected more, which is what I've talked about in my previous video. Oceania Healthcare is facing a lot of cost headwinds, so management did confirm that they're trying to get the government to increase the funding for the retirement industry. So hopefully that will translate into higher revenues, and that will offset some of the cost inflation that we've been seeing. But this is a headwind, and this is something that the business will need to increase their prices to offset. If they can't increase their prices, then this care model really doesn't work. So that's something to keep note of. Other things to note is that they mentioned that inquiries have been at a higher level now in Auckland, especially after the lockdowns. So hopefully we'll be able to see some of this level of inquiries translate into higher profits for the next half year through higher sales volume. So that's the gist of the half year result. Alright, so next stock that I want to talk about is Colins Foods Limited. As you can see, current share price is $14.10. Today is up 12.62%, and this is on the back of a solid half year result. Now, there was a very good growth in the European market, given that the Europeans have now eased their lockdowns. As well as that, another key thing to note is that Colins Food did sign a corporate franchise agreement with KFC Europe. So this CFA, the corporate franchise agreement, includes an outline for the development of up to 130 new KFC restaurants in the Netherlands. So under this agreement, Colins Foods will become KFC's corporate franchise in the Netherlands. What this means is that Colins Foods will be responsible for the development, management, marketing, and support and operation of the KFC business in the country. It will also be responsible for the introduction, management, and oversight of present and future franchises. And as part of this franchising model, the CFA will also provide Colins Foods with remuneration from KFC towards the cost of operating the market. There's also incentives that Colins can earn after achieving certain development and other performance measures milestones as well. So this is a huge deal for Colins Foods. Not only will they develop more stores, but they'll also oversee all the independent franchises, and as well as that, this plan will give them a very consistent and reliable pipeline of growth, which is what I like to see. KFC is a very simple business. They will build an X number of new stores per year. With the CFA, they'll be able to develop more stores in the Netherlands. Coupled with a recovering European market, I think this will do very well for Colins Foods Limited. Now, the other stock that I want to talk about that's not so good is Kogan. So over the past month, Kogan is down about 20%. As you know, in Australia now lockdowns are easing, with New South Wales and Victoria above the 90% double vax threshold. A lot of the economy has now reopened. So now the tailwinds from stay at home is now becoming headwinds as people go out shopping into shopping malls like Centre, which is also another stock that I own in the portfolio. So it's kind of like the perfect hedge. But let's talk about Kogan over here. So this month, the CEO of Kogan, which is Ruslan Kogan, was on the news on the AFR as one of the top paid CEOs. And as you can see, Kogan's pay was about 9 million last year. And if you compare Kogan's market cap compared to the other companies out there, Kogan is just a $1 billion company versus Macquarie, which is a 70, 80 billion odd dollar company, CSL, which is massive, one of the biggest companies on the ASX, versus Newcrest versus BHP. These are all multi-billion dollar companies versus Kogan, which is just a $1 billion company. And that is also one of the reasons why we saw that during the AGM held on the 25th of November, so last week, that the adoption of the remuneration report was very polarizing, right? Usually you don't expect to see such a tight vote for and against. So there were 57% votes for the adoption of the remuneration report and 41% against. So a lot of people are against this, the option plan that the company has with the CEO and the CFO. So I've talked about this before in my previous video on Kogan, but basically the remuneration team decided to award the CEO and CFO options based on a very low threshold, because that was before the pandemic run that the company had. So once they actually approved the options, it was already that the share price was way above the strike price, meaning that the owners didn't really have to work very hard to achieve those shares. So that was the key concern that the market had at that time, and it is still one of the key concerns today. That's why we've seen such a polarizing vote. And when you see something like this, it's very obvious that some shareholders will not be happy and will sell out of their shares, which is why we see the share price come down quite substantially even after the shareholder vote. But another piece of news as well that's caused some panic is that the CFO has decided to sell some shares, which at the time was roughly around $11 million. So it's not a good look when an officer decides to sell their stock, and this is actually quite a lot of stock as well. So this definitely did not give shareholders any confidence that the management team was being good stewards of the company and acting in the interest of shareholders. And it's also no surprise that Kogan is one of the top most shorted stocks, because this was a long time running now. They've always been one of the top shorted stocks, so it's very easy for the share price to swing 10% on one particular day with no news whatsoever. And personally, I did overestimate how much of an impact the stay-at-home play had on Kogan. I was thinking that with the second wave and third wave of lockdowns that Kogan will be able to perform well. However, I've been proven wrong, and personally I'll be holding, because at the current share price it's definitely not a sell for me. But that is all for today's video. Hopefully you guys enjoyed the update, and let me know what you guys think about the stocks in the portfolio. And remember, if you do decide to sign up with Sharesight, I have a referral link down below. You get 4 months for free using that link. But thank you guys for watching. Until next time, take care.